are ping-ponging back off each other.
People are seeing this, and those memories of fear are coming back.
Procter & Gamble. Procter's trading at 60.
What the heck is going on down here?
On the day I recorded this video, the NASDAQ 100 index, that is the index consisting of the largest American tech stocks, crashed 2.3%. And as is normally the case in these situations, FinTwit, that is financial Twitter, was up in arms about it. If you've been in the markets for a while, you know that stocks, contrary to popular opinion, don't always go up. In fact, they tend to be rather volatile compared to other asset classes, and they go up and down all the time. Up 2%, down 2%, it's all a daily occurrence. However, there are times when stocks will go down by larger percentage points and over larger periods of time, and it's these situations that we call bear markets. More specifically, a bear market is defined as a 20% or more decline in the level of large stock market indexes. In fact, the term can even be used to describe drawdowns in the prices of individual assets, but most frequently it refers to major losses in the major stock market indexes, such as the S&P 500, the Dow, or the NASDAQ 100. Now, we've all read our Buffett quotes, and we know that the best thing to do in the markets is to be fearful when others are greedy, and greedy when others are fearful. However, at times, it can be easier said than done. Typically, when the stock markets go down 10% or more, talking heads and pundits will come out with all kinds of hot takes about how the next 1929 is coming, about how stocks are going to go down forever, or about how the US economy is going to implode.
Extreme.
Logically speaking, the lower the price of an asset is, the greater the chances that it will be higher at some point in the future, provided that it's an asset of some quality. However, when most of the self-professed experts online, on TV, are talking about doom and gloom, it's very easy to be infected by their pessimism. The basic principle of stock investing, buy low and sell high, sounds pretty simple. The problem is the buying low part. Typically, in order to get an unreasonably low price in an asset, there needs to be an environment of extreme perceived risk, and you need to correctly judge that the risk is lesser than what people think it is. That's easier said than done, and it's one of the reasons why picking individual stocks is an extremely challenging activity and why most people don't succeed at it, and why, generally speaking, the vast majority of investors are well advised to dollar cost average into index funds, that is, buy on a set schedule regardless of whether the markets are up and down, rather than try to time the market or make investments in individual stocks. Now, the basic definition of a bear market is pretty simple. Prices go down 20% over a prolonged period of time. The bigger question is, how do you identify a bear market while it's ongoing, and how do you react when you're in one? Fortunately, we have two very good case studies from recent history. In the past 3 years, there have been 2 bear markets, and in both cases, investors were able to make money relatively quickly after they occurred. The first of those, of course, was the legendary March 2020 COVID-19 bear market. At that period of time, governments around the world were shutting down their economies, wreaking havoc in sectors like airlines and retail. Stock prices dropped 30% across the board very rapidly. Later, when second quarter earnings came out, it turned out that tech companies actually made money from the lockdowns rather than losing money, because all of the people who had been shopping at retail stores previously flocked to e-commerce stores like Amazon and Alibaba instead, resulting in windfall profits for those companies. As a result, the March 2020 bear market was very, very short-lived. The other bear market that we experienced recently was the prolonged 2022 bear market in tech stocks, which occurred when A, interest rates began to rise as the Federal Reserve tried to combat inflation, and B, tech earnings began to slow down dramatically because they had earned so much previously during the era of COVID lockdowns. In both of these bear markets, there was a lot of money to be made. The March 2020 COVID crash was one of the most short-lived bear markets in history, lasting only about a month or two. By July, new highs were already being set. If you had bought tech stocks or even just an S&P 500 index funds at the March 2020 lows, you'd have made off very, very well, very, very quickly. In 2022, likewise, tech stocks hit a bottom around December of 2022. Year to date, in 2023, the NASDAQ is already up over 40%. Again, if you bought the lows in that bear market, you would have made out very well. So basically, when a bear market is underway, what you want to do is ignore everyone who says the sky is falling, ignore all the predictions of the next 1929, and actually buy stocks rather than selling them. Emotionally, it feels very counterintuitive because human beings, being a social species, have a herding instinct, meaning a tendency to want to do what other people around them are doing. However, you need to think independently and critically if you want to invest in stocks, particularly if you want to invest in individual stocks where there is no diversification benefit and you really need to know what you're doing in order to succeed. Now, you might be thinking, but what about if one day there were a bear market that never turned around? What if stocks just stayed down forever? Well, funnily enough, there is a historical situation that resembled that very closely. That is the situation in the Japan Nikkei index in 1989. In 1989, the Nikkei index began a many decades-long bear market that it actually still hasn't fully recovered from. If you had bought the top in 1989, you would still be down on a price return basis and down even worse adjusted for inflation. That sounds pretty bad, but keep in mind the principle of dollar cost averaging. If you had bought progressively into the Japanese stock market over the decades, you would have gradually gotten your average cost down and eventually gotten to a point where you were profitable on your Japanese investments. Today, many smart investors, such as Warren Buffett, are betting big on Japan and reaping big returns by doing so. So, is a bear market something to be afraid of? Many people will tell you that it is, but if we look at the facts, we can see that it isn't. Stocks generally recover after they go down by a large percentage points, and even if a stock market index crashes and never retakes its all-time high, you can still turn it into a profitable investment by dollar cost averaging. In investing, the future is always uncertain, but as long as you have a plan, you should be able to perform reasonably well over time. That's it for me today. Happy saving.
Everyone else is watching, and they're seeing these big negative numbers, and their confidence gets affected.
They are ping-ponging back off each other.
People are seeing this, and those memories of fear are coming back.
Procter & Gamble. Procter's trading at 60.
Ask them what the heck is going on down here. I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.